Hey guys, it's Boris. Welcome to the new week of trades and Trader Fade for the first week of April. The calendar this week is, relatively quiet. We do have a couple of flashpoints worth taking a look at. Obviously, we have the RBNZ rate decision on the 5th. We're going to take a look at that. I've been negative Aussie for quite a while, and I'm wondering if it should be a sort of a sell the event type of an event. We'll take a look at the charts again more carefully, but I've been biased short Aussie continuously because I thought the 75 handle was pretty much the figure at which point it should start to retrace some of its movements. We're going to take a look and see if that confirms my thesis. Right now, it's sort of, I think, just been very, very stationary. It'll be interesting to see just how hawkish RBA will be. At this point, the market obviously not forecasting a bump on the cash rate, so we'll see if they're going to just signal a further hawkishness going forward. But that is definitely the kick of the week, the start of the week as far as the event goes. Then ISM services, this is post-fact after the NFPs, so far less interesting and important unless it's truly horrible. The key thing here is, we had a relatively decent NFP number, growth rates, everything. I mean, yes, I know it's all subpar relative to inflation, but the important point is that nominally it still continues to be quite good on the inflation, on the growth front. So the critical thing here is going to be to make sure that the services component continues to stay. Market is looking at a 58.6 against the 56.5, obviously a huge bump. Even if we come in at 58, it'll still be good. The most important thing is the delta, the rate of change has to be positive in services growth because that's really the big story. Can we come back on the services front in the U.S. economy in order to maintain this very, very healthy pace of growth that we've had? FOMC minutes, I think, are not going to reveal much. They're hawkish without wanting to be hawkish. Nobody really cares. Everybody has projected the dot plot already into the forward space. As I said, at this point, much of the FOMC tightening has kind of been factored in. So doubtful they're going to say anything that's going to really surprise the market. And then end of the week, we have the CAD employment data. That'll be interesting as well. Should be actually sort of fascinating from a lot of respect. I mean, market is obviously looking for a significant decline relative to the gangbuster number that we had in the prior month, but still a decline in the unemployment rate. But my point is, I think it'll be interesting to see if the energy sector has a serious contribution, given the very, very large move in oil that we've had over the last couple of months, whether that's going to reverberate throughout the Canadian economy, and also whether the comeback from COVID and kind of a reopening of the massive services sector is also going to do well. Generally, I'm super bullish Canadian economy. They are incredibly well balanced in this permanent high bid oil market, combined with obviously tremendous amount of safety, combined also with the fact that they can really be a net marginal additional producer of wheat and some of the other commodities that are going to be shortchanged because of the Ukraine situation. So they really sort of stand to benefit from all the turmoil the world is over. I think the loonie is bid on a cross basis and on a relative basis as well. All right, let's take a look at charts and talk about where we are on everything. I'm kind of going to go macro, panoramic. I like this big chart view. So we'll take a look at the more panoramic view of equities and everything else. My argument last week was that we were very bullish, and I was right. My bullish bias on equities remained accurate, and I said that the 15,000 obviously is going to be the big resist level, which we did come off the 15,000, and now it's very, very hard to tell. I mean, basically with equities you have to be net bullish until proven otherwise. At this point, yes, we got rejected off the 15,200. Obviously, it would be massively positive if we can come up to some sort of a diplomatic solution in Ukraine. Hard to tell. On the one hand, they seem to be making serious negotiation progress. On the other hand, just the war crimes that are going on in that part of the world are so horrific to even think about that it could just create a tremendous amount of bad blood. Very hard to tell, really, where the Ukraine situation goes. That definitely has some impact on equities and on just risk sentiment itself. That having been said, though, you sort of have to really respect this very, very sharp V-shaped rebound. yes, a natural retrace off the 15,000. Now, really, the story becomes much more interesting of how you want to, if we hold the 14.5 and maintain a bid throughout the week, and more importantly, if we can just really clear this 15,200, it's a very, very bullish construct for equities. For now, you sort of have to give the benefit to the doubt to the bulls, but be cognizant that yes, we could certainly have the rug pulled from underneath us here. I would say 14.5 on a closing basis. We get down there, the posture has to change to a little bit much more of a cautious position. But for now, the benefit of the doubt is to the upside on the equity front. Let's take a look at oil, because oil was another interesting, very, very interesting story. We talked about last week about the idea of how the SPR, the release of oil, could be, very, very negative for oil in the short term, create a little bit of sell-off. Obviously, the idea also that any kind of diplomatic solution probably unleashes all this Russian oil that's just simply sitting in storage right now on the downside. The other story here that's oil bearish is the continued lockdown in China. This is a very important story that I don't think the market is appreciating as much as it should. Or certainly the price is reflecting it, but perhaps the analysts are not really paying as much attention to it as should. In the sense that, we have these rolling blackouts all across major urban centers of China as the Omicron wave comes back through in Asia in kind of a very vicious format. And that obviously is having a very dampening effect on demand. So that having been said, though, I still remain completely much of an oil bull, both on a technical and a fundamental basis, simply because there just isn't enough oil right now for the global recovery demand that we're seeing. Yes, when you're looking at this technical chart, and look by the way, on this big panoramic view, you have this huge parabolic blow off, secondary test, which is lower. This is all negative technically. Yes, definitely, absolutely, but not detrimental, because ultimately what you have is higher lows over here at these levels. We caught the bottoms here. The market tonight, as I'm starting the week here, struggling with the 100 barrier, and we certainly, definitely could test the 95. I mean, in fact, if I were sort of a betting man, it's probably much more likely that we're going to press it down to the 95s as the bears try to flush everybody out of the market. But to me, very much still a buy to dip story, especially around these 95, 92 levels, because this is exactly the kind of price action that would take out the weak longs out of the trade. Now, we get down to 85s, the story changes. They were really just completely broken horrendously, and I'm absolutely wrong on the bias. But my bias here is do not chase the highs. I think the breakout's still very vulnerable because there's quite a lot of overhead here, but it's much more of a buy to dip story here. So if we're coming down to 96s, have a positive day. A positive day off the 95, 96 base, probably a very good trade for at least a run towards the 103, 104s. Overall, oil to me is a kind of a buy to dip. Either you buy to dip or you stand back down. Not a trade here where I'm perfectly happy, shorting the lows, which is definitely a very dangerous and kind of a stupid trade because the possibility for another vertical move to the upside definitely exists. Gold, which was very bullish going into last week, excuse me, I'm so sorry, which was very bullish going into last week, kind of died at this 1950. Gold is truly in a sort of a consolidated phase. What's interesting about the consolidated phase of gold, and what can you talk about? There is no fundamentals in gold. Gold is a completely nonsense asset that trades purely on sentiment. But which is why I'm not even trying to analyze the market from any kind of a fundamental point of view. But what is interesting from a technical point of view, if you look around there and look at this, let me just see if I can show this to you visually. Look at this rock solid support at this sort of 1920, 1950. This was what was this? This was around 1915 highs, right? This is June of 21. What's impressive technically here is you have this parabolic move to the upside. Consolidated phase here, but the consolidative phase is finding buyers in this 1900, 1920 zone, and I think really unless we close below, and this is a critical thing, we have to close below on a daily basis 1900. Bias in gold still remains to the upside. We may just simply consolidating here for quite a while. We seem to be in a tug of war. Neither the bulls nor the bears can really move the market much, and that's because I think everybody, it's reflecting so many different things. It's reflecting sort of the caution of the market relative to the Ukraine situation and whether we're going to get escalation or not, or de-escalation. It's reflecting the caution of the market as to whether this inflationary pressure is going to be accelerating or decelerating. All of these things are interesting. It's reflecting the fact that whether real rates are expanding or declining. That, as you can see, the market now across all assets is in a hesitation mode, much more so than it was a couple of weeks ago. It's much harder now to read direction than it was a couple of weeks ago, which is why the proper situation here is to simply stay with the trends or stay out of it. In other words, as I said, buy the dips, maintain your posture relative to what the posture has been over the near term horizon, and otherwise stay cautiously out of the way, because you really don't have much of a clear passage here either way. Now come back to Bitcoin. Here's an interesting chart. So again, very big panoramic view. I hope you guys like this kind of a longer term panoramic view, because it gives you a much richer understanding of where the price action is. What's happening here, though, and looking at it tonight, is not exactly pleasant. Another fake out? I mean, seriously, is this just another yank job by the crypto bros? Because if you sort of look at where we're at, everybody in crypto was telling me, listen, Boris, Bitcoin is a 35-45 trade, right? So this is 35, here's 45. It's a 35-45 trade. We take out the 45s, that's where you go. You go that way, we take out the 35s, that's where you go. And I think that imminently makes sense. But of course, markets never make it easy, and it's never that simple. So yes, the bias here certainly looks to the buy side. We certainly have buying pressure, as you can see on my chart here. All of the technical indicators, all the momentum indicators suggesting that yes, absolutely, this move and bid down to the 45,794, probably a decent scale down buy, which is probably where you want to be. I think if the net takeaway for trading this week is you want to be a scaled down buy, meaning you're buying the dips, you're buying more dips, you buy more dips until really truly serious levels are breached. So if we're going to look at that on an asset by asset basis, that's actually probably a good way for us to think about this. We're going to look at if we're going to be a scaled down buyer. So we want to be a buyer of NAS here all the way till about 14.5. If we get to about 14.5, we got to stop, and at 14,000, we definitely need to be out. But I would be out at 14.2. I'd probably be out even at 14.4, because then you're just completely wrong. The whole breakout move to the upside has been rejected. So you're scaled down buy here around into the 1400s to about 14.4 on NASDAQ. On oil, obviously you're a scaled down buy here. I would say I'm actually willing to be a buyer here all the way down to like 92s, which is probably too much, and you probably going to be too stubborn to want to buy it. But oil is a very volatile trade. You're going to have to give it more room than reasonable in order to try to hold on to that positive bias. But yeah, I definitely want to be a buyer at 99, 95, 90, 94s. At probably 90, you want to be out of it. Even if 90 is the fake out, in other words, they tick it down to 90 and it actually is the bottom, just not worth it, because at that point you're just so deep into retrace territory that any kind of a bounce is going to be anemic, and you're probably going to have to change the posture to at least a neutral to negative. So scale down buyer at those levels for oil. For gold, as we said, this 1900 to 1920, that's the magic level. That's where you can be accumulating. If gold closes below 1900, you're out. That's my uncle point as far as gold goes this week. Now with BIT, same kind of story. You buy 45, you buy 44. I would say I am out on BIT at mid-range here at 42. I mean, that's not it's just simply a risk point there, and it's not that I'm making some kind of a wildly intelligent chart point on this chart, but it's a matter of managing your position. You should never be at the 42 if Bitcoin is truly bid. We should just be buying this dip here. Buyers should come back tomorrow, the next day, and we should really be looking towards the 50,000. That's the thesis. That's where we're targeting. If we're getting down to the 42s, there is, you're not looking at 50,000 and you want to be out of that trade. You're absolutely wrong on that position. Now, saving the best for last, my better calls. What was my strongest call last week? Let's short the yen crosses, right? So that wasn't, a perfect short, but it wasn't a bad one. So like this was the kind of the end of last week. I mean, look, CAD yen 99, so it came down to 97. Dollar yen, definitely, that was a great trade. I got blown out. I was sort of shorted and scaled out positions. I was at 23. I got taken out at 23s. I got taken out at 24s. I came back at 25s. Badoom. I made it all back and then some on the move. We're a little, tepid here. Well, the one trade that I'm trading now, that I'm fighting, fighting the spike here is the euro yen trade. I got taken out at 35s and 36s. I'm back in at around the 35.50s. I need to see effectively, I think euro yen has a reasonable chance here to come down to the 34s. That's my problem child on the yen crosses, but I still remain relatively bearish on all the yen crosses because I think we have room further to come down after such a huge overbought condition. And then the other big story, of course, is Aussie. In terms of, as I said, my view that Australia kind of deserves to. Now, this, by the way, this is a very, very important structure. My view is Australia is a sell at these levels for, resistance, overbought conditions, blah, blah, blah. I don't think the RBA is going to be as aggressive. They got a problem with China. China slowing down is not going to be a situation that RBA wants to hike into aggressively at this point. So you have, a whole bunch of technical and fundamental reasons why you definitely want to be short Australia. But I will say this, if price closes through 75.50, really maybe, and if it just closes at 76, you are so wrong. You need to just dump it like like a cheap suit, because the price action will have completely reversed all of this stall resistance action, and something, even if the RBA isn't hawkish, something in the perception of the market will have changed so radically that you do not want to be fighting it at that point. So my view is, we're going to be short this thing. We're going to try to fight it. We're going to move it. We're going to see if we can move it down to the 74s. But if this thing starts closing at above 75.50 on a closing basis, and really, the last point is if it starts closing at 76, we're dumping it. That's my view on the Aussies, and of course all the Aussie crosses. And then last but not least, we have CAD coming up end of the week. That's going to be a sort of an end of the week trade. The trade that I've been fighting very, very hard, finally starting to work for me, the Aussie CAD trade. So, that was a trade we sort of were short around the 94s, trying to get it down to 93s. It's a very slow trade. You have to, this may take you another week to resolve. But again, if I'm trading the Aussie weakness, this is the trade I like here, from 94s down to 93s as on the relative strength of, Canada versus Australia as we go down to, to the downside. Here again, if we close 94.50 on a closing basis, I am so wrong. I want to just be out of the position, because that will definitely, prove my thesis wrong. So that's essentially how the week shapes up. A lot of interesting ideas on a more muted basis. I think you have to be, as I said, buy the dip with very, very hard risk parameters on your positions. But overall, we're still positive risk essentially as we enter the week. I wish you guys best of luck, the best of trading. Bush Lossberg, over and out.